So let's just dive right in. The single biggest assumption in Canadian real estate, this idea of, infinite population growth, it just hit a brick wall.
The huge one.
We've been running on this thesis that demand is just limitless, but the Q4 2025 numbers are in, and they shred that narrative.
They really do.
Canada's population didn't just slow down, it actually contracted by 76,000 people.
It's a massive demographic shock. And it forces you to look at this new report, which I think perfectly calls this era the Great Recalibration.
Okay, so what does that mean? It's not a crash, but something else.
Exactly. It's a decoupling. The old link between population growth and asset performance is, well, it's breaking.
And I'm guessing that decoupling is hitting multifamily first and maybe hardest. For years, the playbook was so simple. Buy a building, raise the rents, you profit.
Not anymore. This report calls it the Great Normalization. National in-place rents. They only went up $9.
$9, quarter over quarter.
To $1,746. I mean, that's effectively flat. And vacancy's up to 4.5%, the highest it's been since 2020.
Right. So the data is basically screaming that we've hit the affordability ceiling. Tenants just can't pay anymore.
They can't.
So if you're an investor who penciled in, say, 8 or 10% rent growth to make your deal work, you are effectively underwater now.
You are. You can't squeeze any more out of the asset. And that realization is causing capital to look for a new home. The question is, where does it go?
This was the most counterintuitive part of the whole report for me. You'd think with the whole e-commerce story, retail would be dead. But it's flagged as the defensive champion.
It is, yeah.
Is that just a supply story?
It's almost entirely a supply story. Nobody built strip malls for a decade. Everyone was chasing multifamily and industrial. So now there's this supply mode. Grocery-anchored centers are thriving because there's just zero new competition coming online. It's really the only place where landlords still have pricing power.
So while retail tightens, the office sector is seeing that violent split we keep talking about. It feels like the flight to quality isn't just a trend anymore. It's the reality.
It's two completely different markets. Downtown Toronto absorbed 2.7 million square feet. Companies are using this moment to upgrade.
But the flip side?
The flip side is the suburban Class B offices facing an existential crisis. If you have an old office park out in the suburbs, obsolescence is a very real, very near-term risk.
And usually industrial would be the safe haven here, but the report flags a tariff risk premium. I assume this really changes the math for logistics hubs near the border.
It does. With effective duties of 4 to 6% on exports to the U.S., the risk profile for any tenant in cross-border trade has just spiked. A warehouse isn't a bond anymore.
It really seems like this recalibration is happening to borrowers, too, especially when you look at Quebec. That Quebec paradox section, it just jumped out at me.
Yeah, that was interesting.
Legal mortgages, which are basically liens for unpaid secondary debts like condo fees, they surged by almost 17%.
But here's the kicker.
Yeah.
Actual home repossessions. They dropped by over 40%.
So people are defaulting on the small stuff, the taxes, the maintenance fees, but they are fighting tooth and nail to hold on to the actual title.
Correct. It's a story of high stress, but very low capitulation. Owners are using every tool they have, consumer proposals, extending their amortization, anything, to keep the asset off the market.
That just screams that a localized strategy is the only way to play this. You can't just bet on Canada anymore. I mean, just look at the difference between Halifax and Calgary.
It's massive.
Yeah.
Halifax is leading the country with 6.1% rent growth. Meanwhile, Calgary is a high-risk outlier, negative 1.3% rent growth and 6.1% vacancy.
Wow.
If you are betting on broad averages in 2026, you are going to lose. You have to be micro-focused.
And if you can't rely on that big rent growth to drive returns, the only lever you have left is efficiency. I guess that's where that agentic AI part of the report fits in.
Precisely. If your revenue is flatlining in multifamily, you have to cut operating expenses. And this agentic AI, it's not just a chatbot.
Right.
These are autonomous agents scheduling maintenance, even negotiating lease renewals. It's the only way to protect your margins when you just can't raise the rent.
It's a fascinating pivot from growth at all costs to efficiency and survival. Okay, before we wrap this up, what's the one thought that's sticking with you from this deep dive?
It all goes back to that first number for me. The entire valuation model, the entire thesis of Canadian real estate was built on aggressive population growth.
Right.
If that 76,000 person decline, if that becomes a trend instead of a one-off anomaly, does the fundamental value of everything we just talked about need to be completely rewritten?
A heavy question for the year ahead. That's it for this deep dive. We'll see you on the next one.